That's what was so annoying with this law. It wasn't thinking about small firms.
Little tech.
Exactly. The best way to think about deductions from a tax perspective is you want more cash now, right? So if you can accelerate all those deductions now, you can lower your tax bill by 10K versus maybe like 2K. Accelerate deductions, defer revenue is a goal under taxes, right?
All right, Jake, thanks so much for joining the Startup Growth Podcast. We've got Jake Wedig here, Director of Tax at Fondo. Jake, tell us a little bit about your background and why you love tax.
Yeah, for sure. I mean, when I just think about tax, I mean, it's a fun thing all the time, right? I mean, I'm really fun at parties, but when I think about my background and like everything, worked at PwC at first, got Big Four experience. I've worked in industry now, other public accounting, and again, just all that stuff's great. But I really want to be intentional with clients, so started to think about how I can be more intentional. Fondo came up with this opportunity 2.5 years ago, and it's been amazing ever since. What I love about tax is, I guess when you think about the two ways most people go from accounting, there's audit and tax, right? I don't know, tax, I felt like I was always saving clients money. You felt really helpful with that planning and strategy versus, and again, audit's amazing too, but like audit kind of seems like it's a requirement you spend money to just be in line with. I like that I was kind of working towards my client's interests through tax resolution. And I really loved it. And I love that, again, at Fondo, that even becomes more impactful because, again, when you're thinking about tax liabilities, there's such a huge cash flow issue with it. You are being mindful about like how much your client's spending each year. Again, they kind of live and die by that cash balance and their burn rate. So I love that part. You really feel like even more intentional in this type of space. And I'm a little entrepreneur at heart, so it's been great to kind of help entrepreneurs scale in the right ways. But yeah, no, I've loved it so far. And it's a really exciting time right now for tax with this new tax bill.
Yeah. I mean, okay, let's go there. So what's going on? So we've got the one big, beautiful tax bill, or sorry, the one big, beautiful OBB. Okay, one big,
yeah.
beautiful bill. There we go. So okay, so there's a lot of good stuff in there for founders and business owners and for the startups themselves. So where should we start?
Yeah, for sure. I mean, this just got signed into law on Friday, so 4th of July.
Mm-hmm.
Really, once it got, again, through, I want to say, the Senate, it really moved fast through the House. It was kind of crazy how it was a blur. Honestly, I was not expecting it to move that quickly to get resolved and signed into law. There's a lot to digest. I want to say, don't quote me too much, but I think it's over 900 pages, this bill. There's a lot in it, a lot of good things, a lot of interesting things, some interesting cuts. But what I think the main focus I want to think about is on the client-facing side. It's like there's a lot for startups in this bill that they need to be mindful of. And there's also, again, I know we don't focus on the individual and founder as much. We kind of support as we can, but there's a lot also for founders to consider.
Yeah, let's
just
talk about all that.
Yeah. So again, I think starting off with the business side, right? I mean, that's what we focus on. From a startup side, like the big thing I think about is like R&D credits, right? That incentive. So if you develop something in the U.S., let's again, like think about your wages, contractor costs, hosting costs, whatever, to develop a new product, new service, whatever, there can be incentives from the IRS to essentially get you cash back. This is a tax credit, right? That's been always great. That's been governed or dictated by Section 41 of the Internal Revenue Code. Again, I'll be saying a couple code lines here that might get a little confusing. But Section 41 gives you that R&D credit, which is a really big incentive that we offer, right, to our clients. That's defined, that research under that code that gets these nice tax credits for people, that's defined under another code section called Section 174. Section 174 has been really annoying for a lot of clients these last couple of years, as we've seen. Back in 2017 with the Tax Cuts and Jobs Act that was launched at that time, there was this sunset provision that after 5 years, so 2017 to 2022, they, again, without going too much in the mechanics of it, they had to think through their budget and make sure that they weren't overspending or not collecting enough revenue through these bills. They had to add a provision where essentially any business that had R&D activity, they had to add back those expenses and amortize them over either a 5-year life if it's domestic or 15 years if it's international. Again, yeah, and so it's revenue it's a revenue generating process for in the taxes again because taxes are there for two main reasons: incentives and revenue generating, right?
Yep.
So this would be the revenue side.
Right. And this is the interesting thing about this because you mentioned R&D, right? This is all centered around R&D. So what is R&D for startups? That is all your payroll headcount
Yes.
for product and engineering. So designers, developers, founders, people building the product, creating something new. It's like I know there's some specific criteria to be considered R&D for the R&D tax credit, but research and development, this is really important for startups, right? All of your payroll related to building new products and all of your associated. So there's two buckets, like you said. There's section 41, which is related to the R&D tax credit, which is payroll, right? And then there's section 174 that you mentioned, which is related to R&D, but it includes payroll, it includes health benefits, it includes office space allocated to those engineers, it includes health insurance, it includes all the expenses kind of around the R&D as well. And so, kind of what really hurt everybody was all of a sudden all of those expenses after they enacted Section 174 were no longer deductible against any of your revenue. And so now you kind of have, or not fully deductible. So in the scenario that you're a startup and you're making $400,000 a year in revenue and you have $300,000 in R&D spend, 100,000 in other expenses, so you have 400 in income, 400 in expenses, you have zero profit, and so you would have no taxes owed, right? And on that 300,000 in R&D spend, you would probably get about 30,000 as an R&D credit. You would get that $30,000 cash back. So before this tax rule, you were in a situation where you had 400,000 in revenue, 400,000 expenses. You're getting $30,000 back as a check from the IRS. After 2022, like you mentioned, it got enacted, Section 174 rules for your 2022 tax return, your 23, your 24. It looked different. So you had your 400K in income. Now instead of taking 300,000 in R&D expense, you're taking 30,000 because as you have the first year,
Half year
is even
convention.
less, half year convention. So now you have 400,000 revenue. You can only take 30,000 of those expenses plus your 100,000 in other expenses. So now you have 270,000 in profit, taxable profit, because of Section 174. So now you're going to owe, at the 21% tax rate, you're going to owe about $56,000 in taxes now. And it's the same company, same situation. Previous to this rule, you would owe nothing and get money back. Now you owe 56,000. You offset that with the credit, so you still owe about almost $30,000. So you went from getting $30,000 in credit to now owing 30,000. You did that for 2022. You had to do that again for 23 and 24, and now all of a sudden that's not required anymore. Now you can go back to taking those full deductions. So now you have your revenue, you're offsetting all of your expenses. So now you're back to not owing taxes. You're back to getting the cash credit, the full amount. So what does that mean now can you amend those prior year returns to get back some of that money that you paid? Like, how does this affect all the, it's in effect going forward, right? So now Section 174 is gone. Is that right? Starting with the 2025 tax year?
Yeah, so this Section 170 for capitalization is going away starting with 2025 tax year. When I think of considerations for amendments, there's a small business exception. I don't want to say exactly what that number is. I believe it's like 31 million or something, like of gross receipts in prior years is going to trigger the ability to amend if you want.
Okay.
Amending really from a cash flow standpoint, it's only going to be impactful for clients that got pushed in those taxable positions. Again, because there's also going to be an offering, which again, there isn't full guidance on yet, but there's going to be the ability to do catch-up deductions for any amortization that still hasn't been taken for the next year, which might be the best opportunity for some clients. But again,
Interesting.
yeah.
Okay, so amending. So if I'm a startup and I'm wondering, should I amend? It only makes sense to amend if you got if you pushed into a taxable position because of Section 174.
Exactly. It's going, and again, there might be clients that just want that cleaned up anyway, which, and again, I think that, and it's going to be a case by case basis to think that through, but there's going to be opportunities to just accelerate those deductions or catch up those deductions next year.
So okay, so how does that work? So that's probably the biggest question on everybody's mind, right? Because you're seeing like, okay, this is reversed now. Okay, good for me going forward, but like maybe I didn't, whether I was pushed into a taxable position or not, maybe I used my tax credit to offset that taxable position.
Exactly, and that's
yeah.
And that's going to be one where you want to maybe think about amending. Again, it's going to be the pros and cons, which a lot is up in the air on this, which makes it so exciting also as a tax nerd.
Yeah.
Like there is those pros and cons, like the administrative burden of it, of amending 3 years of filings potentially. Like you mentioned, some of that, you were going to get a payroll tax credit, right? Like, because the R&D credits can either be applied as a payroll tax credit, which essentially is just cash back against your payroll taxes paid, or an income tax credit. So it's offsetting taxes that would have been due on your Form 1120, your corporate tax return, right? If they had taxes due, right, because of this push up, it was an income tax credit. Now we have to amend their return to get them that refund on the taxes they had to pay in, and then that offset now needs to be amended through their Form 6765, their R&D credit form, to make sure that we check the box for payroll credit, and then we have to amend their payroll forms to capture it. So it starts to become like this whole snowball effect that they have to think through the cash flow purposes of it and what that cost to administer is going to be.
Interesting.
Them. Yeah.
Do they have guidance on amending for the payroll tax credit? Like, is that...
Yeah, there is stuff out there that, again, so we'll be able to support that as well. There is complexity to it, but there is a way to do it. And that's what's so interesting with all these layers now. Again, because this wasn't a thing till 2022, and now it's getting reversed a few years later. It's creating these weird tranches of R&D for people to deal with and kind of figure out. But it does open up a lot of tax planning opportunities about what is the best cash flow opportunity for a startup. Do they need the cash now? What's the refund going to look like? Again, without going too much into it, IRS has a lot of delays right now in processing, so some of these startups might not be around even if they try to amend these filings to get the refund. It might be better to, again, accelerate those deductions to the next year when maybe they're making revenue and can capitalize on all those expenses. Because the one thing you think about with this from plan opportunity too is we can accelerate all these deductions next year, or I think they offer 1 or 2 years of catch-up. Like you can either prorate it through 1 year or 2 years. Let's say a client makes $100K next year, right? In profit. They have all these NOLs. You can only use 80% of NOLs though, usually. So they can only get down to 20K of profit next year. We amended, that would be the story, right? They can only limit it to 80%. Let's catch up these deductions. They can utilize all of those because they're being treated as a current year expense. So instead of only getting 80K, maybe there's 100K of catch-up amortization they can use now. That's going to, again, reduce that 20K profit to 0 or more. So that's what's kind of exciting about this. Like, it's going to be client by client or startup by startup, depending on their needs at that point. And again, there's a lot open though. I mean, like, because the administrative burden of amending might be worth it because who knows what this election is going to look like. It's going to be an easy election where you just fill out a statement and add to your return next year, or is it going to be a whole accounting adjustment change where we need a Form 3115 and a 4081A adjustment? Like, we don't know exactly how they're going to draft that up just yet. There's some murmurs about what that might look like. It seems like it might be a simple election, which I'm really hoping for, but you just don't know. But again, that's why we're really focused on this, to make sure we do the right thing for all of our clients based on their circumstances.
And so what are the steps that a startup should take, and working with a professional like Fondo, like what steps should they take to see if they should consider amending, or consider doing nothing, or consider, taking, it sounds like you could take those unamortized deductions and amortize them all this year, or all this year and next year. Like what is the process to think through that in the tax planning process?
Yeah, for sure. I mean, startups, you don't know what you don't know kind of thing with this. I really think the first step is reaching out to your tax advisor, whoever they are, to kind of understand the last 3 years of activity for your startup. Again, understand, have you been paying in taxes due to this add back? Have you been receiving the R&D credit that you were expecting throughout the years? Have you been getting, because if you have been getting your R&D credit the right way through payroll tax credits, because you're, again, an early stage startup. If you haven't had to pay taxes in or anything, you want to kind of stay the course you're going, because it's going to be more administrative costs for you to pay someone to amend those returns for you, deal with refiling those amendments. Also going to flow into your state returns. It's going to create ripples in your state taxes that might create some issue with those payments too. So you just want to be really mindful of that, in making sure that how this all rolls up is effective. But again, it all comes down to talking to that tax advisor, having those conversations, thinking through your cash flow, and then also think about your goals for this next year. Like, where are you trying to go with your profit this next year? Are you going to be profitable? Would it be helpful to be able to capture more deductions next year than to amend and have an NOL that's capped by 80%? Like, those are other things we have to consider too. And it's really going to be looking at multiple years.
Oh,
of tax.
interesting.
Yeah.
Interesting. So if you amend, you will have a larger net operating loss that you can carry forward, but you can only take 80% of that in this next tax
Exactly.
year, or you can elect to fully deduct those unamortized expenses this year, and that's like 100%. And
Exactly.
and so that seems to be the analysis that's really important. Is like, do you increase your NOL, or do you increase your NOL for this year? Or, like, the big question is, if I was a non-revenue generating startup for the past 2 years, was my R&D credit affected by Section 174?
Yes.
Okay. And then the question is, by how much? And then, okay, is that amount worth recapturing through amendment or not?
Exactly. So a lot of moving parts. But it's exciting. I mean, this is a really great opportunity to, I guess, again, not to promote us, but it's a really great opportunity right now to evaluate who your tax advisor is and making sure they're thinking about these interests for you. Heck, even everything we're talking about right now, they could release guidance next week that completely flips the script of, like, maybe these accelerated deductions are capped at 80% for some reason. There's some layer. There's so much open, but that's why you have to be agile with this. You want a tax advisor that's being agile with it, right? Taxes evolve. I mean, this bill being passed, these things happen every 5-10 years, essentially, right? Usually with a different administration coming in, or with these sunset rules that happen 5 years after bills. You have to have an advisor that's being mindful of that and trying to be proactive to ensure that you're getting, again, those cash savings you need, especially in a startup environment where, yeah, cash is king.
Yeah. And the quick shout out to Fondo right now. I mean, when you work with Fondo, you get sort of the best of both worlds, right? You get an accounting platform paired with accounting experts like Jake that sort of advise you during these sort of transitions to help you make those important decisions to set your business up in the best way possible from a tax perspective. Maximize your tax credits, minimize your taxes owed, and make sure you're in compliance. So big shout out to Fondo. Yeah, we can. If you're interested, you can get started with us pretty quickly. It takes less than 3 minutes to get started, and you can kick off a call with your tax advisor. So yeah, so continue that conversation. Let's say you had zero in income. You had 300K in R&D expense last year, so you had a $30,000 credit. How was that $30,000 credit impacted by Section 174?
Yeah. You're going to get a little mathy here for a second, so sorry about it.
Let's do it.
But what you're talking about exactly is, like, kind of the big issue that comes up is, let's say you had revenue of, like you just said, so let's say you had revenue of 300K, you had expenses of 300K, all those expenses are R&D, they get added back. You would be at zero if 300 minus 300, right? Normal circumstances. That add back's pushing you right back to 300K of profit, right? So I'm going to try to be really simple with this example as much as I can. I'll be saying some percentages, but let's say you had 100K of 100K of R&D expenses. You're in a profitable position. Doesn't matter what that number is, but you have 100K of R&D. Usually you'll get a deduction of a full 100K before 2022 and now going forward. Under Section 174, what they said was, okay, that 100K needs to be added back for taxes and then amortized over 5 years for domestic, with that half-year convention the first year. So you're getting an add back of 100K to taxable income minus 10K, right? Because it's 5 years amortization, $20,000 per year, but there's a half-year convention, they call it, for that first year. We can only take half the amortization, so it's 10. So 100 minus 10 means you have a $90,000 taxable income impact. So it's almost again, and the times that by 21% our corporate tax rate. you're looking at, hopefully not bad mental math, I believe that's 18.9K of tax income or tax due, so tax penalty you can call it. You have that R&D credit as well that you're hopefully claiming. That R&D credit usually ends up being roughly 10% of qualified R&D expenses. So if you had $100K added back under Section 174, you have about $10,000 worth of credit under Section 41, the R&D credit code, right? So we have 10K of tax credit. You have 18.9K of tax penalty. That nets to an 8.9K penalty for taxes due under Section 174, all things considered. That's what was so annoying with this law. The idea of this law, Section 174, was again to kind of stop misappropriation of funds at large organizations who were kind of pouring money into R&D just to avoid paying taxes. Like, again, think large corporations. It wasn't thinking about small firms who have to develop to survive.
Little tech.
Exactly. And so that's where this issue came in. It caused a lot of startups to be more hesitant to claim R&D because they didn't want that exposure to 174. I think there's a lot of lost opportunities or lost, again, not as aggressive credits claimed due to it. And not because of good faith issues, but just because they're worried about, again, just being penalized when they didn't have cash to support paying for this Section 174 capitalization.
Yeah, and you said, I think you put it really nice. I mean, taxes are to either to incentivize or to penalize. And it was almost like Section 174 was penalizing investing in R&D, which is such a, un-American thing to do. So it's so now that's reversed. So you're not getting penalized for investing in R&D. So we talked about if you had income, if you had revenue and you had R&D expenses, we talked about how you ended up overpaying your taxes now for the past potentially 3 years. So you've got to decide, is it worth getting that extra 10 grand in the R&D credit over the past few years? So maybe you're talking 30, 50, 100K in cash back from the IRS if you go back and amend, or do you take that unamortized deduction, fully amortize it this year, and maybe that bumps up your R&D. Could that bump up your R&D credit this year?
It would. I don't think it's going to bump up your R&D credit this year.
No.
That's the thing.
So
But it will allow you to maybe be able to claim a payroll tax credit that you otherwise wouldn't have claimed in the current. Let's say, like, maybe as you scale, right, throughout the years, hopefully you're getting more wages, more payroll, more development, right? So maybe there was only, you said there was 10K credit, like the 100K, so 30K each year with the 10K credit. But maybe this year they're at 500K of payroll tax potentially, but they're in a profitable position. Maybe they can essentially get a 50K payroll tax credit this year. They're going to forgo a 30K they could have gotten last year on it, right? But with that, again, I'm getting lost with words, but with the acceleration of the deductions, they're now pushed into a loss position. So that 50K is not going to be an income tax credit. It will be fully a payroll tax credit. So there's all this, again, there's a lot of moving pieces.
Yeah, there's a lot of moving pieces.
Yeah, you have to think planning, perspective, and
Okay, so that's for revenue generating companies. Now, what if you're a pre-revenue company? And let's say you were a pre-revenue company. Let's say you just have 1 year, to keep it simple. So you had 1 year last year. Let's say you spent $1 million. Your pre-revenue company spent $1 million in R&D. What did your R&D credit look like last year under Section 174?
Yeah, so if you're pre-revenue, so again, just spending money, your R&D credit is going to be a payroll tax credit. Again, because you had no income taxes to pay in, you can make the election on your Form 6765, your R&D credit form, and you can get any development costs that you spent as cash back, essentially, that 10% roughly. So that's great. That's not changing with these changes, right? It's changing for those pre-revenue types of companies that were already got their payroll tax credit. The biggest change they'll see if they amend is that they'll increase their NOL. End of day, is not impactful though, because they'll be able to accelerate that deduction to 2025 and still get the NOL that they were expecting.
Got it.
Just 1 year later. Yeah.
So if I'm a pre-revenue startup incorporated in 2024, I spent $1 million in engineering and payroll co-founders. I got $100,000 R&D credit last year, but because of that $1 million R&D spend, I only took a 100K net operating loss, because 900K of that million is to be capitalized over the next 5 years. So I have a missed opportunity of a 900K carry forward NOL. However, I can only utilize that net operating loss, that 900K, 80%. So 900. So I can take 720 of that this year
Yep, if you're in taxable
as an
income.
NOL. Or the other option is go back and amend. Sorry, in this scenario, you'd only have 100K NOL. And so you're missing out on that 900K NOL. And so if you go back and amend, now you can get K of NOL from last year that you can carry forward. And the question is, how does that line up against this year's numbers and next year's numbers?
Exactly.
And it sounds like for most startups, if you were pre-revenue, the value of that NOL is not as valuable as just taking last year's unamortized, undeductible expenses and just taking them all this year.
Exactly.
It's not going to change your R&D credit last year if you were pre-revenue. It's just going to change your net operating loss, but you can actually you're in a better position to pick up 100% of that this year versus 80% of it by going back and amending.
Exactly. And again, beautiful thing about pre-revenue is it's all these adjustments that happen, or majority of adjustments you're going to see are timing differences or temporary adjustments. So like this R&D, it was going to be, you're going to, at some point in the life cycle of this of your company, you're going to get the benefit of those deductions. It was just going to be spread over 5 or 15 years, depending if it's domestic or international. And now you're getting it essentially like a pre-revenue company that started just last year. They're getting that benefit in a 2-year time frame versus getting all last year. So it really isn't a big deal from a cash economic standpoint if they had no money or no taxes to pay in the first place. That's a nice thing. So that hopefully some people can rest easy with that logic. But again, with all that said, don't be ignorant to it. Definitely talk to a tax advisor, have that open conversation, because you don't know what you don't know in a day.
Totally. Yeah, and every company is a little bit different in this. You might have been pre-revenue last year, but today you might have gone from 0 to 10 million ARR in 1 month because you are building the next best AI tool that is like spreading like wildfire. Yeah, there's definitely a few things to consider. So that's section 174. So like to summarize, it sounds like section 174 really hurt companies the past 3 years. It basically made companies have taxable profits where they otherwise would have losses and more tax credits. Now that's been reversed. So you no longer carry that burden of taxable profits when you're not profitable. And you have an opportunity to amend prior years to maximize your credits this year, to pick up missed credits in prior years. And to do that analysis, it's really helpful to talk to a tax advisor to say, okay, what did I miss out on? What can I get back? Or should I do nothing and just go forward and take advantage of this change, capitalize this year by taking undeducted expenses last year, taking them all this year, and then move forward under the new tax laws that are more favorable to startups.
Exactly. And I think you hit the nail on the head with that process. The one caveat I want to bring up is, again, this is just impacting domestic research. International is still going to have the 15-year amortization. That was not included. It will be interesting. Again, I think the big things I think about is for R&D credits, I think there's going to be more aggressive claims for R&D credits now that there's not that penalty of add backs, which will be, again, a unique thing to see how that plays out. The other thing is, will this shift innovation? Again, I think that's the goal with the incentive piece versus just revenue piece. Will it shift innovation to the domestic side versus spending on, again, more maybe cost-effective labor or contractors in a different country? What will that do?
Yeah.
So it'll be interesting to see that interplay, but again, only time will tell how impactful it will be. Again,
I mean, I think that's a really good point. I think that is a helpful example to go through. So let's say you had $1 million in revenue, you had $1 million in domestic engineering, investment in R&D. Your whole engineering team is in the U.S. So you have, 5 engineers there are 10 engineers. God, let's say you've got. Let's just keep it simple. You've got 10 engineers making $100,000 a year, all in the U.S. $1 million in revenue, $1 million in expenses, 0 in profit. You're going to get $100,000 R&D credit in that scenario today, in today's situation. If that $1 million is not domestically spent on R&D, if that $1 million is spent on international talent, now you've got 900,000 in profit that you're going to be taxed on. So you've got 900,000 at the 21% rate.
Yeah, it's even I think worse if I'm telling you the
Oh,
truth,
right,
like
because the
because it's
15, it's
15
over
years.
30. So
Yeah, so
it's
it's you only can take a 30th of that a million
okay. So
add
1
back
million.
as amortization.
So you can only take 33,000
Yeah,
as
it
expenses. So
hurts.
now you've got a million in revenue minus. So now you've got 900 and what is it?
67.
967,000 in taxable profit at the 21% rate. 200,000 and so wow, I mean that's pretty insane. So if you hired
Right?
everybody, all your engineering in the US, you're going to end up getting $100,000 check from the IRS. If you spend that $1 million on international talent, now you're going to owe 200,000 to the IRS. So now your effective cost for hiring in the US is 900,000 and your effective cost for hiring internationally is 1.2 million. So it really changes the thought on how you're building your team and where you're recruiting from.
Exactly. It's going to drive it. I mean, there's going to be a lot of intangibles to consider as well, like in how effective can your team be. And there's going to be payroll costs, right, too. Like if you have $100,000 of wages or $1 million of wages in U.S., there's payroll benefits and things like that. And it might create more exposure to state filings, right? Because those international contracts aren't creating nexus for you from a state filing perspective. There's so much to it. But again, that's what's I don't want to salivate, but like this is really from a tax nerd's perspective. There's a lot to consider, and you really want a your tax advisor to really be in the weeds with you on this process because there's a lot to be saved from a tax cash flow perspective by how you set this up.
Awesome. Well, thanks. So that's a great recap on Section 174. What are some other changes that we should talk about?
Yeah, these we can do more highlighted, but like bonus depreciation's back. So essentially, if you're spending money on equipment, usually you have to depreciate it over its useful life, whether it be 3, 5, or 7 years. Bonus depreciation allows you to take 100% of that in the current year. There's two types of accelerated depreciation you'll see. There is bonus depreciation, which I just mentioned. That allows you to depreciate an asset 100% this year, and it doesn't matter if you're in a loss position or not. There's also,
And does this apply? What
yeah,
types of, who does this apply to? So this is individuals and this is pass-through entities. Is this as well as
oh,
C Corps?
so yeah, this is anyone taking depreciation. So it can be your S corps,
Anyone
it can be
taking
your C corps.
depreciation?
Yep. So again, if you buy a really nice computer, let's say for 10K, that 10,000 can be depreciated right now versus taking it over 5 years, right? So again, the best way to think about deductions from a tax perspective is you want more cash now, right? So you want to accelerate deductions, defer revenue is a goal under taxes, right? So if you can accelerate all those deductions now, you can lower your tax bill by 10K versus maybe like 2K under normal depreciation rules. That's what's cool about this. It's the goal of that is to incentivize investment in your company. Again, if you're spending money on equipment, you're kind of rooting your company in a different way. That is getting really good incentive. I mean, the manufacturers love this kind of stuff. It's letting them build their products. And again, from a startup perspective, also it helps you build your teams, your office, your remote teams, making sure that they're better equipped, and again, getting that cash savings.
Wow. So with accelerated bonus depreciation, now for every $100,000 in depreciable assets that you're purchasing, you're saving like 21 grand in taxes potentially for every 100,000
Yeah, I mean, pretty much that first year, exactly.
that
Again,
first
obviously
year.
and it goes through each year. There's always different considerations, but that's what makes it really cool. And this is different than Section 179 depreciation, which is another form of accelerated depreciation, which I won't go too much into, especially
Well,
with our companies.
Section 179 is for those founders who are buying the G Wagon or who are buying the SUV as a tax deduction. Can you talk about what the way people are using 179 and what it's intended for and how people use it?
Yeah. To speak like, because again, a lot of our companies we deal with are in loss positions, so bonus depreciation is always going to be the better answer to classify as
Yes.
because bonus depreciation can always increase your NOL. Section 179 is limited. And I wish I remembered the new limits at. Is it? I'm not going to say because I want
Is
to.
179 even in this bill?
There is. They increased the limit that you can take, so it's actually more. But the one
Here,
thing about
let's check. Let's check
179,
what that
yeah,
is. Let's check what that is. Section 179 limit. Okay, so the maximum was 1.2 million,
Is it 2.5 now?
and the new deduction limit is, yeah. So okay, so the big beautiful bill increases the Section 179 deduction cap from 1 million to 2.5 million.
Hey, there we go. I actually did read it. Love it.
There
Want to
we
make
go.
sure before I said it. So yeah, it went to 2.5. The thing about Section 179 though, it's a great way to classify assets when you're in a profitable position because it can reduce your it's again able to reduce your taxable income by 2.5, right, what you spend. But the thing is, you can't go into an NOL with it or net operating loss with it. Bonus depreciation, you can. Bonus depreciation, you can create an NOL or create a bigger NOL with. That's why bonus depreciation is a little more impactful for a lot of our startup clients who are pre-revenue or
Got it.
spending a lot. So that's why we see it a little bit and why,
Interesting.
yeah.
That's very interesting. Okay, so that's bonus depreciation. So what was bonus depreciation limit before the big beautiful bill?
So bonus depreciation is a newer thing that came with 2017's Tax Cuts Jobs Act. The one thing was it was phasing out. So it went from 100% depreciation to 80%, and then I think this year it's 60%. So it keeps on going down to phase out. They essentially said we're going to extend it, not only extend it, but we're going to make that 100% bonus depreciation the new standard. Kind of revamping it back up as they were starting to phase it out and eliminate it. Yeah, I don't think
Okay,
there's any
all right.
amending rules with that. Yeah.
Okay, so we covered Section 174, Section 179, bonus depreciation. What's
Yep.
next on the list?
Again,
QSBS. Should we talk about QSBS?
yeah, we can talk QSBS. So, qualified small business stock. Essentially, if you are a startup and you have an initial issuance stock, so like stock given to the first founders or your first employees or whatever, if you hold that for 5 years, you're able to get it. Again, there's some caveats to it, but you're able to get an exclusion of up to 10 million on your capital gains by selling that stock. So again, it's trying to incentivize founders to hold their stock, invest in their company, and really build it before they turn around and sell. Like without going too nuts with the math, but yeah, if you had a $15 million gain and you held QSBS with a 5-year holding period that you have to do in the requirements and met everything else with what QSBS offers, you're not going to be taxed in the first 10, but that 5 million that's left, you have 5 times 0.15%, just looking at that's $750,000 worth of tax due on the 5 million capital gain. That doesn't get the 10 million exclusion, right? For QSBS, under the new laws though, now you can get a 15 million exclusion. The other cool thing about it is it's a tiered exclusion now. It used to be like 5 years or nothing. Now it's a tiered exclusion where 3 years, so I'm looking over here because I have my notes, 3 years is 50% exclusion, 4 years gives you 75%, and 5 years gives you the 100% exclusion for 15. So there's like it's allowing people to sell earlier than it used to. So it's meant to get founders to be like, okay, I can sell a little earlier, I can hopefully save a little more so that I can go into the next big thing and create something great again. So it's again trying to spark quicker innovation, stronger innovation, continued innovation under
Wow. I
this
mean, it's a
rule.
huge benefit. I
Yeah.
mean, it saves millions of dollars in taxes.
Yes.
For 10 million, it was 1.5 million in savings at least. And now at 15 million, it's going to be over 2 million in savings.
Yes. And one thing to say about this is it's really exciting. If you're a founder now, this only applies to stock issued after this enactment.
Right. So
So just keep in
if you're
mind, yeah.
thinking about incorporating your company, now's the time.
Exactly.
Start the clock now, incorporate as a Delaware C corp, and sell in 5 years, and you'll get the full 15 million tax free on the federal level.
Exactly. Yes. Yeah. So it's
Awesome.
a really great incentive again to be mindful of.
Awesome, Jake. Well, this is really helpful, and let's definitely continue the conversation soon. But really appreciate you coming in and enlightening us with with all these changes and how they impact startups and founders. Any parting words?
Right now, and again, just be on the lookout. Finally, we're going to continue to release communications on this stuff. We are here to help you. If you ever have questions, just reach out, whether it be LinkedIn, you are a personal client of ours. Reach out via Slack, whatever. We are here to support you because there's going to be a lot of changes. There's going to be a lot more guidance that comes out and things to analyze.
Yeah,
Thank
awesome,
you
Jake.
again for having me.
Yeah, thanks for joining us, Jake. And yeah, I just want to echo Jake. At Fondo, we would love to help you think through this stuff. So if you're already a Fondo customer, reach out to your a dedicated tax advisor. We're going to walk you through this stuff and make sure that you're getting your maximum deductions this year, that you're maximizing your tax credits. And if you're not a customer yet, check us out. We'd be happy to hop on a call with you, get you onboarded to Fondo so we can help you think through some of these tax opportunities. So thanks, Jake.